Hi everyone, my name is Cantrelle and Gwen and I will be presenting our analysis of Chipotle Mexican Grill, focusing on the capital structure, bond issues, IPO history, stock performance, and return on investment. This presentation builds on our earlier financial ratio analysis but expands on the bond and stocks trend to determine whether Chipotle is a strong investment opportunity.
From 2022 to 2024, Chipotle's capital structure steadily improved, reflecting lower financial risk with stronger stability. The debt to assets ratio decreased from 0.66 to 0.60, showing that a smaller share of the company's assets is financed through debt and that it now relies more on internal funding. The debt to equity ratio declined from 1.93 to 1.52, meaning that Chipotle uses less borrowed money for each dollar of shareholder equity, which reduces long-term risk to increase financial security. The interest coverage ratio remains strong, proving that Chipotle's high operating income easily covers its small interest expenses and having a profitable cash flow.
That Chipotle trades at a premium compared to the rest of the industry. Chipotle market value ratio shows consistent, strong investor trust. Earning per share rose from 0.64 to 1.11, meaning each share earned created more profit, providing more high operationals. Price to earning ratio declined from 65.48 to 37.52, but remaining high compared to competitors, showing investors still values Chipotle growth potential. Book value per share increased from 1.69 to 2.66, reflecting stronger assets with equality growth, while the market to book ratio though dropped from 24.64 to 15.66, indicating the company's stock remained valued far above the accounting worth.
Chipotle's financial trends from 2022 to 2024 show a consistent shift towards sustainable growth. As profitability and cash flow strengthened, the company was able to fund new projects and expansions without relying heavily on external borrowing. Rising sales from digital orders, price adjustments to offset inflation, and expansion into the new markets boosted operational cash flow, allowing Chipotle to reduce its debt load and lower financial risk. This trend of decreasing leverage and higher internal financing highlights how Chipotle is positioning itself to maintain financial flexibility while minimizing exposure to rising interest rates.
Chipotle financial example. Chipotle doesn't rely heavily on long-term public bond issues like some other companies, but it does use bank debt. A good example is 600 million unassured revolving credit facility established in 2020 to help provide a little extra liquidity during the COVID-19 pandemic. Even though this is a credit line rather than a traditional bond, it functions similar. Chipotle can borrow funds up to a limit, pay interest on the borrower's earnings, and repay by a maternal date. This shows how the firm selectively used debt when needed while still maintaining a very strong balance sheet.
Since Chipotle doesn't issue traditional bonds, there are no typical bond features like coupon rates, par values, call provisions, or sinking funds. Instead, their debt comes from a $600 million unsecured revolving credit line. The interest rate is variable. It adjusts with secured overnight financing rate plus a margin, and the facility expires and renews on a multi-year cycle rather than having a single long-term maturity. This gives Chipotle financial flexibility, especially during times when additional liquidity might be needed.
Because Chipotle does not issue public bonds, the company does not have a Moody or S&P bond rating. If it did issue bonds, its strong cash positions and consistent profitability would likely result in an investment grade rating. The absence of bond issues also signals that Chipotle felt confident in relying primarily on internal cash flow rather than external long-term financing.
Why choose to use debt instead of equity? Well, even a company with low overall leverage can benefit from debt financing in specific situations. Raising debt instead of equity avoids issuing new shares and diluting existing owners. Interest on debt is typically tax deductible, which can make it cheaper than equity on an after tax basis. Short term credit facilities are a flexible way to handle temporary liquidity needs without committing to long term bonds. Because Chipotle generates strong operating cash flows, it can take on limited debt when necessary. Overall, issuing debt allows Chipotle to raise funds efficiently.
Chipotle Mexican Grill went public on January 26, 2006 at an offering price of $22 per share. About 7.9 million shares were sold, raising just under $200 million in proceeds. Investor demand was very strong, with the stock prices doubling on the first day of trading, making it one of the best restaurants IOPs in years. Proceeds was used primarily to fund new restaurant openings and expand supporting the growth that investors were excited to see about.
This chart shows Chipotle's adjusted daily closing prices over the past 3 years. You can see three major phases: a steady climb in 2023, a sharp acceleration into mid 2024, and then a broader decline through 2025. The peak occurs in mid 2024, where prices reach the mid 60s before reversing. Towards the end of the timeline, the stock falls back towards the low 30s. The purpose of this slide is mainly to highlight how much movement occurs in a relatively short period of time and to show the overall shape of the price cycle.
The upward trend throughout 2023 and early 2024 was driven by strong earning reports, with a steady restaurant expansion and a positive reaction to Chipotle 50 for one stock split. Investors priced in the high growth expectation during this period contribute to the stock reaching its peak. The decline that followed in the late 2024 and into the 2025 reflects different factors such as rising labor, ingredient costs, slower same-store sale growth, and a general pullback in restaurants and consumer stocks. The forecast was revised downward and economic uncertainty grew. Investors became more cautious, which led to the sharper drop needed to the end of the period. This slide focused on the causes behind the movement rather than the movement itself.
These return on investments calculations compare what an investor would earn if they bought Chipotle stock at different past dates and sold at the price on November 21st, 2025, which was $31.63 adjusted close. Using the formula return on investments equals ending price minus beginning price divided by beginning price, we calculated returns for the IPO date 3 years ago, 2 years ago, 1 year ago, 1 month ago, and 1 week ago. For each period listed, we compare the price at that point in time to today's price. This helps show how profitable Chipotle would have been as an investment over different periods of time.
Over the long term, the company has shown a strong gain, a 43.77 return from its IOP in 2025, which demonstrates that Chipotle has created a substantial shareholder value throughout steady expansion, rising consumer demand, and a solid profitability. In the medium term, Chipotle achieved a 5.82% gain over the past 3 years, indicating modest but positive growth despite external challenges such as inflation, rising labor costs, and June 2024 50-to-1 stock split, which temporarily adjusted share price. However, the short-term performance reflect a period of significant downward pressure with a 1-year ROI of a negative 47.28% and a 2-year ROI of a negative 28.01%. These declines stem from a post-split market correction after a previous high valuation slowed restaurant sales growth, and the continued cost of inflation in both wages and food supplies affected it. In the very short term, the stock has stabilized around the 31 to 32 range, suggesting that prices has coincided after the correction.
When comparing within the industry, Chipotle generally outperforms peers on profitability and return on equity, which reflects efficient operations and strong brand power. Liquidity metrics are also healthy, and leverage is relatively low, which reduces financial risk. On the other side, the market often prices Chipotle at a premium valuation, which can increase downside risk if growth slows or negative news appears. But overall, these comparisons further suggest that Chipotle is a strong financial performer within the restaurant sector.
Combining the box and stocks, Chipotle showed a high financial stability with a low debt, with a strong credit rating, with really steady stock performance with a constant growth. Their financial choices had a low risk while performing a long-term value to investors.
Based on all the financial ratios, IPO history, bond analysis, stock performance, and return on investment calculations, Chipotle appears to be a strong long term investment. The company's fundamentals are solid, growth remains strong, and risk is relatively low due to minimal debt usage. Short term volatility exists, but long term results are consistently positive.
These are our sources used to gather financial data and background information. All value come from a reputable source, including Yahoo Finance, Moodle, Moody, SE Finley, and Chipotle owned investor relation page.